Welcome everyone to our first webinar in our Capital Insights series. Thank you so much for joining us today. This series is meant to provide information and to have a discussion on topics related to funding your innovation startup, to help entrepreneurs expand and scale their businesses. Today's session focuses on developing your funding strategy and why it is crucial to have one. I'm Petra Stegman, Senior Director at Connect, where I lead our Springboard program. Connect is a nonprofit, and for over 30 years, we've worked with life science and high-tech entrepreneurs to help them grow and scale their companies through the various programs we have to offer. We have a stellar panel lined up for you today, so let's get started. It gives me great pleasure now to introduce today's moderator, Victoria Lakers. Victoria is a partner at Caliber One, a global executive recruiting firm focused on C-suite roles for VC and PE-backed software companies. Before that, she held several executive roles in investor-backed technology startups. She also owned and sold 2 businesses. Prior to that, she was in capital raising for 2 private equity firms, Water Asset Management and Apollo Global Management. Victoria is also a board member at New Fund Ventures Group and the Air and Space Museum. Welcome, Victoria.
Thanks so much. Really appreciate the introduction and appreciate being here with everyone today. I'm very excited to introduce our panel. With that, I'll invite our panelists to come on camera. Spencer, you popped up first. So Spencer with Concert Health, do you want to give us a quick overview on you?
Sure. Great to see everybody. My name is Spencer Hutchins, and I'm a co-founder and CEO at Concert Health. We're a 7-year-old behavioral health medical group, scaling an organization in the digital health space. Prior to this is my second company that I founded and led that was venture-backed. And prior to that, did a mix of management consulting, working in a family office, and public service work. I was in the first term of the Obama administration.
Great. Thanks for joining us today. Paul, over to you.
Thank you, Victoria. Pleasure to be here. I'm Paul Voice. I'm a managing partner at CoFund. We're a seed stage venture capital firm based in Orange County. We invest exclusively in early stage startups in Southern California and probably do about half of our investments in San Diego County. So very happy to be involved in this event. I've been with CoFund for 6 years or so. We're on our 3rd fund now. Prior to that, I was an entrepreneur in the semiconductor industry. So went through the entire journey from conception through venture funding, growth and exit with a company called Clarify Communications based in Irvine. We built semiconductors for high-speed networking chips, successfully sold the company, and it's now part of Marvell Semiconductor. But today I am a full-time venture capitalist and enjoy working with entrepreneurs and startups, and pleasure to be here and look forward to the session.
Great. Loving bringing together the investor mindset and then 2 really great CEOs. So with that, Dan, over to you.
Hi, everybody. I'm Dan LeBlanc. I'm the co-founder and CEO of Dacity. We are a data analytics platform for consumer brands. Paul is actually one of our board observers, as CoFund is an investor in Dacity, so super excited to have him here. And we were a cool company with Connect. So for those of you out there that are thinking about, capital, I highly suggest that you look at the Cool Companies program with Connect in San Diego. It's a great way for VCs to learn about you.
Great, Dan. Thanks. I'm sure Connect appreciates the plug and seconds the great program as well. So with that, we'll kick it off with questions. So Paul, as we launch into it, would be super helpful if you could set the stage and just talk about a little bit about the various stages of funding and high level what that looks like through to exit.
Sure. Well, I guess for starters, every startup journey is a little different. So I'm just talking in generalities here. But typically what we see is an entrepreneur or a team of founders get together with a concept, and start fleshing out that concept, making it into a business plan and an actual business. Typically they bootstrap in the very early days, working with no pay for sweat equity, so to speak. And usually the first funding is some combination of friends and family, as well as the founders themselves, with the goal of getting to some type of proof of concept and product market fit that enables them to go for a more institutional funding. And I think angel investment can fit in there somewhere, usually after friends and family, but maybe before institutional venture capital. But at some point, a company is ready to raise their first institutional round, which we typically call seed. The nomenclature can vary a little bit. But that's often a raise of maybe $1 to 4 or even $1 to 5 million dollars, and really, enables the company to. They've probably already commercialized their product, but really, start penetrating the market and growing revenue. And then it's a pretty long, it can often be a long leap to Series A from there. You might be right at early revenue or have a couple 100,000 or maybe $1 million in revenue at Series C, but especially these days, it's a pretty high bar to raise Series A. So typically you'll see a company at 5 or even 10 million of revenue at that point. So I think that might be the hardest jump from one round to the other that startups face. I think we sometimes call it the valley of death. So you want to have a very strong set of Series seed investors to help you bridge that gap. But then it's the alphabet. It's Series B, and at higher levels of revenue, and it's really a matter of how far and fast the company wants to grow in terms of how much capital it raises versus getting acquired versus going the whole way to IPO. Often for an IPO company, you'll see 4, 5, 6 stages of institutional capital raising a total of 100 million or even hundreds of millions of dollars, whereas other companies might exit for a good return after Series A or Series B. So it really depends. But that's typically the venture journey. Some companies just kind of hit it right on the mark early on and don't need that much capital, and good for them. But that's kind of how venture progresses.
Great, thanks, Paul. And then you have some of those companies like the ones I work with where they jump off midway through and have a PE exit or something along those lines, and then the risk profile changes a little bit. With that, Spencer, would love to dig in deeper from the CEO side and talk a little bit about the type of considerations you had and what that funding path looked like for you from Series Seed A, B, and also as part of that, how you sized the round, right? Because the point is to get to exit and still have some of the equity when you do that. So if you could tell us a little bit more about that, that would be wonderful.
Yeah, I really always, I think in all three of those stages that we've gone through, seed A and B, at Concert Health, it's really starting with the same 3 starting points, which is know what your plan is and actually believe it. I think there's sometimes venture capital is good at content marketing. So you think about, how do I fit my aspirations into your model? And I think that gets people in trouble. It's like, what are you actually planning on doing? What will you accomplish? How much money and time is it needed to accomplish that? And then the second is really understand what if you're going to take external investment, sort of what are you going to get comped on, right? For many businesses, that's revenue, right? So, but not necessarily biotech or some other places in which there may be IP or other traction, right? I think in harder markets, it's more and more the financial measures that will really run the day, as opposed to an LOI or an exciting potential partnership that isn't committed, but really understand what that's going to be. And then what other companies are getting on that multiple, right? So if it is revenue, is it 10 times last 12 months revenue or next 12 months revenue? Is it 3 times that? Sort of understand it for the space. And I think, not to have rose-colored glasses on there, understand it. Am I a high growth, high margin business, or am I a medium margin business? And what does that mean? It might mean you have the same comp, it's a revenue multiple, but it might be a very different number. And then really start to understand what that deal might look like in terms of how much do you think you can raise or need to raise to hit those objectives, and what sort of possible range of valuations and things like that would be. I think what's really critical and oftentimes entrepreneurs underinvest in is understanding a bit about the venture business model itself. Sort of what are they trying to achieve with the investment that they're putting in? What are the promises they're making to their limited partners? And I think specifically a really powerful thing is whatever round you're raising now, imagine the next one, right? And that it could either be, I don't think I'm going to raise capital again. I'm going to have an exit, and that's great. Well, what revenue will have? What multiple might you have? So what could that exit be at? What economic value? Or if it's another financing round, what accomplishments will you have, and what will that be? And if you take that same logic of okay, it's a revenue multiple, then understanding what the valuation could be, right? And then obviously you want to create a situation where your current investor is going to be on the same side of the table with you in that discussion. And it's to say, okay, how can they have felt like they got a good deal, right? So if your company is going to be worth $100 million, then, okay, if they can buy in at a $20 million valuation, everyone's happy because they will have generated a 5 times paper return then. And so I think it's really important to sort of wherever you are, fundamentally understand the situation you'll be in a couple of years at the next milestone and think backwards from that.
Great. Thank you, Spencer. I appreciate that. So Dan, diving into more of the tactical piece, as you prepared to go to market for funding, tell us a little bit about the types of things that you got together and advice you'd have on what companies need to do to prepare.
Yeah. Thanks, Victoria. So when we did our seed round back in 2019, and we raised our Series A last January, every stage is a little bit different in the expectations of the venture capital fund. So for most people here, I'm going to, start with the assumption that you're going to be in the seed, pre-seed type range where you are really trying to show that you have product market fit. You're still developing your early on. But what's really going to be important is, do you understand the problem that you're trying to solve? Do you really understand the market that you're going after? That's kind of the main thing that those early seed stage investors are looking for, because they know you may not have it all figured out. As your later stage, they're looking for you to actually know that and really being able to deploy capital to grow. And so for us, when we're back in that seed stage and working with folks like Paul and others in Southern California, we're heavily focused on, this is the problem we're trying to solve. This is the nuance of the problem. Here are the types of customers we're working with. And as we focus on that piece, we also had to tell a story around how were we operationally ready to be able to go and take the capital and expand. So you've got to start to have some basics. We've done things around, we understand. We were using QuickBooks and we had that kind of laid out. We had it very clear around what our revenue sources were, what our cost sources were. They will tell you they didn't believe necessarily our projections, but they liked the fact that we had this sort of infrastructure built where we could quickly go and answer a question. I've worked with some founders where they didn't go and construct their QuickBooks very well, and it took them a month to kind of come back and answer a question for a VC, and that's going to kill you. The inability of you to have a little bit of that infrastructure is going to be really hard. You don't have to be perfect. They don't expect you to be perfect, but you've really have to have that focus, that vision, that mission, and then some of the periphery set in stone or really being able to be well described in order to be able to really tell that story. And so for us, it was having a really good PowerPoint deck or whatever you may choose that clearly outlined, we knew who our competition was. We were able to tell the story. We were able to outline why our competition, why we're different than the competition and differentiated, how that value prop worked for that customer, and be able to provide the financials to date. And so that was really significant. The other part was actually thinking about the actual venture capital funds that we were going after. There were some early on, so folks like CoFund and others, because for us, we're in the tech space, they understood what we were trying to do. It was a very easy discussion. There are other venture capital companies, early stage investors that were in a very different area. And when I had to start explaining analytics, that becomes an increasingly harder problem because they don't really understand that market. So as you're going out to think about the venture capital firms you want to target ones where you don't have to educate them on what you're doing, where you're kind of in the wheelhouse. So for us, we're considered B2B SaaS. Go find venture capital for B2B SaaS. For Spencer, I'm sure, being in healthcare, it's really helpful to find people in the healthcare space. And so I really recommend, that's probably one of the most important things that you can do, because that's really going to help speed up that cycle and reduce the amount of time that you're going to spend talking to venture capital firms.
That's such a great point, Dan. And I think there's not only the education, but also the responsiveness. And if you're spraying and praying to a bunch of people that don't invest in what you do, I think that the engagement is going to be pretty low. And building on, Spencer, you talked about the venture capital model and understanding that. So Paul, I put that back to you just to walk us through how your business model works. And in that context, what it is that you're specifically looking for in the types of investments that you look at.
Sure. And this is super important for entrepreneurs to recognize, because the venture capital business model is much different from an individual company business model. I think the best way to look at the VC model is about portfolio management and asset allocation. So we invest in a portfolio. For Cove Fund, it's typically 20 to 25 companies per fund. And we look for a total return. I mean, obviously, we want the highest possible return, but we're trying to achieve a total return of about 3 times the fund over those 20 to 25 companies in a certain period of time. And you can translate that into kind of an annual rate of return as well. But we know, while we would love for every one of our companies to be successful and to be a home run, we know that's just not the reality. So we mitigate that risk through diversification. In 20 companies, we know that some of them will fail and will, or at least fail in the extent that they won't return capital or only return a fraction of what we invested. We know that some of them will have decent exits. Maybe they'll return 2, 3, 4 times their capital. But what we're hoping is that a few of them have home run exits. So 10, 20, 30 times their capital or more. So what that means for the individual company is we invest in companies. Obviously, they need to have a solid business plan, great team, good market. There's lots of boxes that need to be checked. But one of the criteria with respect to our business model is there needs to be, a path for that company to get a 10x or even more exit. Again, we know it's not going to happen with every company, but the market has to be big enough. The product has to be unique enough. The team has to be able to scale or to attract, other team members that can scale. So you could have a great business, slam dunk, you can say we are guaranteed we're going to exit for 3 times, for 30 million, right, in 3 years, and we're selling you stock for 10 million now. We're probably not going to take that deal because it just doesn't fit into our model, even though for the entrepreneur or for some investors, it's a great deal. So really make sure that you paint the picture to the venture investor how they can get a big return on your company, even though everyone realizes there's a lot of risk. And, it's not, you can't guarantee that return no matter what you say, but there has to be kind of a credible path. If you're raising money at 10 million valuation, there has to be a credible path to a multi-$100 million exit for it to be interesting for venture.
Great, thanks for the overview there. And then, given that you're investing in earlier stage companies, tell us a little bit more about what you look for. Is it personality traits in the founder, early product market fit? Talk a little bit more about what gets you interested in certain deals.
Yeah, I mean, I really boil it down to team, technology, and market. That's the big 3 for us. It always starts with the team. We will take a great team with a mediocre idea over a mediocre team with a great idea any day. Obviously, the best is a great team with a great idea, and that's what we try for. But first and foremost, we invest in a team that we believe understands their business, understands the problems they're trying to solve, as Dan alluded to, and really have the talent to scale the business. And maybe they don't have the team that's going to scale it all the way to 100 million in revenue, but they've got the talent to attract those kind of executives. And then for technology, we want to see a strong moat, differentiation. We don't like me too technologies. That could be IP in terms of patents, or it could just be, trade secret where the company has developed either products or data sets or certain access to the market that are very hard to replicate, the proverbial unfair advantage. And then finally, market size. We really try to focus on $1 billion and more markets. And that really gets back to the business model where, if you don't have a big market, it's just no matter how great your product is, it's hard to scale. That the big three, we love a strong team with a differentiated technology going after a big market. And then, there's lots of other things to dig into, but I think that's a good way to think about it as an entrepreneur.
Great. Thanks for the overview there. So turning it over back to the CEO side, Dan, would love to understand from your perspective a little bit more about the due diligence process, what that looked like, some of the specifics, the time frame, how you had to plan around that full process.
Yeah, thanks, Victoria. So first, for all the founders out there, it's going to take a long time. And it gets longer, the more letters, the further down the alphabet you go. So, with us, our seed series, I think, was a 3 to 6 month exercise. Our Series A was even longer than that. And it becomes more rigorous. In terms of, you really need to have a lot of, so do your homework before you get in. And I talk about things like the data room. They're going to want to see a P&L model, some financials, historical financials. It's not just about an investor deck. They're going to want to see, do you have all of your legal documents? What if you have a board in place? What are the materials that you've shared? They're going to want to talk to customers. And as we've gone into, as Dacity, as we've gone into later stage, they start talking to your customers before you even might know that they're talking to your customers, because they're doing that diligence on you to decide if they want to even start to have that conversation. And so it's really important that the more that you can do up front before you start reaching out, the more that you've done, the faster it's going to be, because time kills deals. If you are unable to go and respond and sort of show that you've got things in order, that's going to, as Paul said, one of the key components is that team. So if you've got more of your back office, your focus all set, you're going to be able to gain that trust because they feel like you can be efficient. If it takes you a month to respond, you're going to be in a lot of trouble. So that's kind of really the recommendation that I have, is we made sure that we had all of those materials, pitch deck, financials, customers that we could introduce them to the next day after having a conversation. We had all of that in place before we really went to market.
Yeah, I think those are all great points. I think a lot about, there's a lot of pre-work if you're going to raise financing as the founder, and getting to know people before you're raising, tell them about the business, get them excited about why, show that you can make commitments and execute against them in an informal way. That ended up being incredibly important. Someone that Connect Mike Kren introduced me 2 years ago, Dave Schwab and Brad Corona at Vertical Venture Partners. I'd had beers with them once, and had been at 2 or 3 calls along the way when they visit San Diego. That became incredibly important because we ended up having to raise our Series A in the first quarter as COVID was descending. And we had this logic that our as a behavioral health business, there's a reason why this could be the moment for us, but there was also a pretty scary time. I was running a process on Zoom, which then seemed very novel, and was also done from my toddler's extra bedroom, because my wife had the proper home office. So I had a crate of boxes on top of this changing table and my laptop there, right? And there was a bunch of folks I reached out to for the first time then, and we didn't go anywhere with them because it was a crazy time. It was those people that I knew really well. But to Dan's point, you should have it all done before: the deck, the data room, right, with the financial model, sort of customer vouchers you should have and know which customers should be. You just know what other elements of your team you want to involve in the process and how. That'll become more and more important later, right? Early, that betting on a team may be a person or a couple of people, right? As you start to move during Series A, Series B, you need to show that you've attracted folks that are on your team now, maybe even also folks that you will hire with the use of proceeds with that next thing as you start to up level and move away from a founding team to an executive team, and having that stuff all ready, and then really trying to time box the period of time of when you start, do as many meetings as you can in the first week or two, because particularly a market like this, time kills all deals. And the thing that will drive to decisions is a reasonable amount of pressure that folks know that you are going to make, whoever invests in you will make a lot of money, right? Because you're going to build a real big business. You understand the milestones, and you understand when you hit those milestones, your company is going to be worth a lot more money than you're currently selling stock at. And that being the case, because that's a self-evident, obvious fact, you're going to talk to a lot of great investors, and the ones that get conviction quickly are going to be fortunate to be on the ride with you, and going to be able to help a lot, right? And then time boxing that, starting those conversations at the same time, opening the data room at the same time, creates that sort of time pressure so people focus, and hopefully gets you a situation where you have multiple term sheets that are offered, and an opportunity to turn the tides and decide which is the best deal and which is the best partner.
Great. Thank goodness for backgrounds, right? I appreciate that insight. I'm picturing it. Tell me a little bit about the targeting process. I mean, obviously you established the relationships in advance, but a little bit more of how you pick the people you reached out to, and if that evolved throughout the various rounds.
Yeah, I'll start, and Dan fill in. I run a big Google sheet, at every round, and the next round's Google sheet starts the day I sign the term sheet for the prior round, right before it's even closed, right? Because you want to sort of say, okay, who are we a little early for? How do you do that? Who is a definite never, and who was maybe not now, the future? And I think Dan made a great point. Is it's hard enough. Like, go to people that understand your space. They're going to be more likely to add value, and they're going to be more likely to create conviction, or get to conviction quickly. And then the second is really understanding the size of their fund, the amount of money you want to raise, and what you think you're going to go and achieve. I think that's really important. We saw, last time we raised our Series B, it was, a year ago when things were pretty different, right? Or really 15 months ago when I started the process. And it was amazing. We had a lot of classic venture folks. We had a lot of private equity and growth equity funds, and there were these crossover funds. One thing that was very interesting was talk to groups like SoftBank and that cohort, and they were sort of like, well, it'd be kind of neat to give you $30 million, to anchor your B, but like, how could we get really excited about a $300 million check that would come soon after that? And it became clear, I was like, I don't think I want to raise 300, or at least I do not want to be preconditioned to have to raise that much money. I don't think, while I think our business could get large enough to justify that, I don't think it needs to burn capital in that same way. And it became really clear that those mega funds at that point where it sort of needed more capital in, from that reason, is they're not trying to turn, the 30 million into 90 million, right? They're trying to turn 2 billion into 6 billion. And you need to be a really, their ownership stake needs to be a material part of and you needs to be a material part of 6 billion, right? And so really understanding that dynamic and hitting it on the head, like, this is what I'm going to do. This works for your business model, and you understand my business model, I think is the lenses you want to have, in addition to just the who's not jerks and things like that, and who has a good reputation.
I like
Yeah,
those.
I'll echo what Spencer said about understanding the portfolio size. That's really important, because what Paul said is they invest in about 20 to 25 funds. And so you have to kind of think about that. If they're 20 to 25 portfolios, and they're 100 million in a fund size, that means they're on average writing a $4 million check. Now you take that and you sort of add an extra zero. Are you really going to be getting 40 million? Your valuation's not there at a seed stage, or they're going to make that investment and you're going to get zero sort of input, feedback, whatever from that investor. And I'll say, if you think you know everything, you're crazy. There's a lot of things that you don't know, and your investors and your board are there to help you. So make sure that you raise capital from somebody where you're kind of a meaningful part of that pool. So you are somebody that's, 1 of 20, and they're going to spend time with you, because it's to what Spencer said with some of the funds that he talked to. We had a very, very similar kind of process as part of our Series A, where we weren't going to get a senior person at the venture capital company. We were so small that it was, yeah, we're interested, but we're interested for later, not for right now. And you guys have to go figure everything else yourself. And you will have gaps in your team and problems that you're going to have to solve. And that's where your investors can be really, really beneficial. And they can also be great in terms of introducing you to other investors. So CoFund was one of our first, and they helped introduce us to other investors that became part of our seed series. So once you get that initial commitment, you leverage them to help you kind of fill out your round.
Great, thanks. So Paul, circling back to you, anything from the investor perspective on what we talked about, diligence, and or any advice for people on how to approach people like you in the best way?
Spencer and Dan laid it out really well in terms of, what you need to do to prepare and really be ready for a full-blown process. I would just add, and this is more towards the front end of the process, and it starts with these two guys have been through it long enough now where they have a really established set of contacts in the venture space. But when you're especially like a first-time founder raising first-time seed, you might not know a lot of VCs, and you'll get introductions from various places. But it's really important to make a good first impression and just to get that first meeting so you can give your pitch. And what I'm coming back to is just the importance of the investor deck. It's simple. I mean, it's easy to overlook, but we use the investor deck as the first screen of new ideas. And we probably screen 500 to 1,000 pitches a year. And probably 80% of those get tossed just based on the investor deck. And I can look at a deck in 3 minutes and give a yes, no. And if it's a yes, I'll ask for a phone call. There'll be a half-hour phone call. So you can find templates from New Fund, from Connect. There's all sorts of great resources on what a good deck looks like. It's 12 to 15 slides. It's the basic stuff. What's the problem? What's the solution? The team, the ask, the market size, the financials. It's not super complicated, but I'm always surprised when companies don't really put a strong effort into their deck, because it says something about their business, but also about their preparation and just their seriousness. So do a good deck. It's not super hard, but it's worth the time, and you'll get a lot more meetings.
Thanks, appreciate it. Going back to you, Spencer and Dan, I think you touched upon a few areas, but if you had went back and redid your fundraisers with what you knew now, what if anything would you change? Spencer, do you want to start?
Yeah, I'd say for a couple things super tactically. For our Series B, we had a couple of very interested investors, and I got the sense that we could have a very big round at a high valuation. And I sort of went out with a pretty large number, right? So if you're talking to generally venture capital, they're going to assume that you're thinking you're going to sell in the neighborhood of 20% of your company, and founders at the peak of their market power are thinking maybe it'll be 15, and venture capitalists are thinking maybe it'll be 25 or 30, but you're all around that average, right? So if you sort of say, I'm raising 50 million, sort of they'll think that means you're expecting a $200 million pre-money valuation ish, one way or the other a bit, right? Sort of on it. And I think one is understand what could be the deal, like what the valuation multiples might support, what you are convinced you could go execute against, and everybody in that next round or the exit having a great outcome. But then probably shoot a little low, right? Because I think what I did is I took a bunch of people that were fairly interested, and then we're like, oh man, he is expecting and will get top dollar. And so we had a bunch of people dropped out. and probably would have gotten more term sheets and more market exploration if we had sort of said, well, let me go out at 70% of what I think I could get in the best case scenario, and then allow a bidding war to get you there. I think it would have helped us have even more options, and helped us not shut down conversations early. The second thing I do differently is when you're doing that check-ins around, like, I'm not raising conversations before a process has happened, but you're relationship building. I think actually being genuinely thoughtful about what it is that you want from, like, what could be helpful, and having really clear non-financial asks for people, so you're not wasting each other's time. So I've now gotten very good. Essentially, I ask everyone to introduce me to customers, right? And it's really clear, like, here's the cohort. It's a primary care group or pediatric or OB group with more than 30 providers in one of the 17 states we're currently operating in, or Minnesota or Montana. So I'm asking everybody on the phone now, if you want to introduce me to those people, you can send them my way. But really specific, like, this is what I want. At times it's been very clear I need an executive. And so the investors know a lot of executives, and it's like, and I need, someone to do customer success. And so either introduce me to someone I can hire, or someone that's great at it and could teach me what great looks like. And I think that conviction, if I had done that earlier, one, some people actually make the introductions and it's helpful. And also it sort of shows that you know how to extract value out of a network, which is something that I think venture capitalists are looking for and are really good at obliging.
That's great. I'm hoping you have a bunch of LinkedIn messages from people giving you referrals.
Yeah.
Dan, what about you?
Yeah, I think for me, I think I would have learned more about what Paul went through about understanding the venture capital initially, especially, in San Diego, where we're in the B2B SaaS space. There traditionally hasn't been a lot in San Diego in that space. It's very sort of defense, military, sort of different sort of technology. And you hear these valuations, and you hear of companies raising $50 million, and I'm in the bio space, and my sort of expectations early on were completely out of whack. And so it was, and I've certainly shared this with some other founders that have gone through the same thing, where you think you want to raise this much money at this valuation, and it doesn't make sense for the venture capital company. And it doesn't actually make sense for you long run. The worst thing that you can do is get too high a valuation and then have a down round later. That's terrible. It's just not great from a company perspective. So, I wish I knew more about what Paul sort of shared back in 2019 when we were first going through the fundraising, because I really didn't know how to have those conversations. And so knowing things like, they're going to want 20% of your company. You can try to get 10, you can try to get 5, but they're going to walk away. And that's because they have a playbook in terms of they need a certain amount of capital, knowing that you're probably going to raise certain rounds that they're going to get diluted and they have to hit their return. And then they also have an idea of what you might sell for, which is also going to determine all that kind of the determination around what your valuation can be, how much capital you can raise. That would have saved me a lot of heartache early on. So that's the one thing I would definitely recommend, is like, go do that. And it's not hard, because I could go look at companies that were sort of adjacent and see what they're selling at, and have just basically done the math back to what did they probably do at a seed stage.
Great.
And really recognize just how crazy the numbers get, and how quickly, to Dan's point and what Paul said, like, Paul Cove exists pretty early in that funnel, right? The seed stage, they're getting it early, and he needs companies that could create enterprise value of multiple $100 million. Like, that is already huge. That's a lot, right? And then, look yourself in the face of, like, who's going to buy us for multiple hundreds of millions of dollars? I think, at times there's a lot of capital flowing around, like the last few years. It was like, oh, I'll get another investment round. But at some point it's like, who's really going to buy at that number? And at every step, really make sure that's what you're signing up for, because that's already a big thing. And certainly if you step through to A or B, those promises get bigger. And it's like, do you really want to do that? Want the pressure, want the expectation, and honestly believe look at people in a straight face that they'll buy you for more than $1 billion.
When I think that founder view of still having some of the company left at the end, right, with multiple
Yep.
stages of dilution. So I know we're going to open it up for Q&A in a few minutes, but the market conditions are obviously very topical coming out of the pandemic. You talked about raising in pandemic, recent SVB. So talk a little bit about both Spencer and Dan mitigating some of the risks, thinking through some market uncertainty, and obviously those are sort of some unusual events, but would be interested to hear how you've been looking at that over, well, in general, but over the past month or so specifically.
Yeah, I'll say for us, we are a Silicon Valley bank and now a First Citizens Bank customer. You have to recognize that there are risks that you know and risks that you don't know, and then risks that you don't think are going to happen, and just be and sort of prioritize the rate in which you're going to go sort of look at those. We were actually having a bit of a risk discussion the day that Silicon Valley Bank, the day before it went under, and nowhere in my list of risks was my bank is going to fail, was going to be on it. But there are things that were really important. So we had a strategic partner back in 2019 when Cove Fund first invested that got acquired and now is, I'll say, still an important partner, but certainly not as strategic as it was. And what was important for us is that was highlighted as a risk that we also identified as a risk. And so we had put in place strategies that we knew that we needed to execute in order to mitigate that risk. And so so as you kind of look through your company, what are the things that could basically take you to zero? And I had one of our current investors, one comment, they made an interesting comment to me. And I don't think it was intended as they're talking about another company that they're looking to invest in. They said, well, we talked about Dacity and we basically figured out that the likelihood that it would go to zero and be worth nothing was very unlikely. As Paul said, like, companies are going to fail. And so that's kind of what made them very interested, or sort of gave them a little bit of safety. And so for us, it's been, how do we mitigate that risk as we sort of go through it in terms of, is it in sales and marketing? Is it in operations? Is it this? What are the different risks that can happen? How do you go make sure that you can take control of the ones that you know about and have plans in place, and then be, prepared, be able to react quickly to the ones that you aren't expecting. And we've had a bunch over the last years. For all of us, COVID, in sort of our space, kind of the coming out of COVID posed its own sort of just changes to the dynamics of consumer behavior, and then to this whole banking crisis.
Yeah, I think those are great points. I'd add just, shit's not fair, and accept that at the beginning, right? You operate in a macro environment. It's fucking crazy that, like, how much different wealth happens depending if you're ready to IPO at the right time, right? I mean, it's bananas, like how much you have no control over that. And I was on this call, and it's like there's this big issue in healthcare about whether antitrust is going to prevent the large health plans, United and Aetna, from continuing to buy companies. And it's like, if they can't buy companies anymore, the M&A environment's going to be way worse. And it was like, my first instinct is like, that's so not fair. Like, people have been able to sell companies to Optum for 20 years. Like, how could I possibly be in a situation where I can't use them as one of the possibilities? And it's just like, yeah, because you signed up for that, figure it out. And so I think that's true right now. Like, oh, if I was doing this a year ago, my valuation would have been, or I read in TechCrunch, someone got this. And it's like, yeah, life's not fair. So, like, deal with that, And I think also really respect that it's a pretty unnatural thing for a business to lose money all the time, right? So, like, really understand, one, whether or not you need to do that, and two, you have conviction, not just that you're capable of raising money so that you keep funding people, but that investment you're making, whether it's an R&D or sales and marketing or whatever, is in fact going to build long-term enterprise value. Like have real conviction that you're going to make the investors money. And that burn is not just this thing we do because we run money losing startups, but is really an intentional way to invest in something that can get a lot bigger, and get your head around that, really believe it. Because if you don't, it's going to be really hard to lie well enough to convince Paul.
Good segue into Paul. So I would put a multi-part question to you, and you can answer both or either. One is sort of the evolution of the venture space in the last couple of years and what that's looked like. And the second piece would be advice as an investor on the risks that you're looking for your portfolio companies to mitigate.
Sure. Well, I mean, it's no secret that the general venture funding market has changed dramatically in the last year. Once we got over the shock of COVID, for the next 2 years after that, it was just go days. There was too much money chasing too few good deals. Valuations went up. I think a lot of bad investments were made, but it was a seller's market in terms of the entrepreneur having the edge. That has all turned in the last year. There's a lot of fear in the market. Obviously, the public markets, the SVB debacle didn't help that. So venture investors have a much higher bar now. Now, the good news and the very, I think, bright spot, especially for people on this call who I assume are primarily going after seed funding, is that the seed funding market hasn't been impacted as much as later stage, with one exception, which is valuation. So if you are a first time, if you're raising your first institutional round, you still, I think, have a good and check all the boxes and have a good business plan. You still have a good chance of being funded. It's just going to be at a valuation that's half of what it would have been a year and a half ago. So you might have a friend that did a similar company that raised their seed at 15 million pre. Today it's going to be 7 or 8 or 5, and we're actually seeing valuations go lower, like quarter by quarter. We're actually starting to see seed deals in the 4, 5, 6 million range again, which I haven't seen since 2018. But we love those deals because they're greenfield. We're not rescuing another seed deal that hasn't made it to Series A and kind of coming in to rescue another venture firm's deal, because we have our own problems. We don't want to do that. We like those new deals. Just be aware of what the market is in terms of valuation, and you can still get funded.
Great, thanks for that. And I'm seeing a number of questions, and one of them was about valuations. So thank you for answering that. I'm combining a couple of the questions as we go through them. And for anybody in the audience that does have questions, feel free to type them in under the Q&A. But there's a couple questions around board seats and what that looks like. And so combining a couple, at what point does the VC look for board seats, and what is that based on? Ownership, size of investment? And then for Spencer and Dan, what does that look like, and how has that changed the power dynamic for you as the portfolio company?
Yeah, so I can jump in. In terms of it's usually you have a lead investor in each round, and they'll want a board seat. You may have some observers. So some of the funds may want observers if they're for them, their equity investment is large enough. I'd say the most important part is not only do you want to find somebody that has capital, but you want to find somebody that you can work with. I think I'm very fortunate in that I love our board. They all have different perspective. We're a board of 5, 2 venture capital, 1 private equity, 1 sort of independent that comes from our space. And that mix is just really good because you've got people that can understand what you need to do in terms of getting to the next stage and come from that venture capital, as well as people that understand your ecosystem, kind of help give some feedback in terms of what's going on in the general marketplace. I've heard horror stories. And so part of your due diligence as a founder is making sure that you've got a team that can work really well effectively, because you have to think of it, it's kind of, you have, X number of bosses and you want them to be giving you the same direction. There is nothing worse than having 4 people or multiple investors telling you to do completely different things. And I've certainly had friends that have gone through that experience, and it's not fun.
Sir Paul, anything to add there?
Yeah, I think one of the reasons to run a competitive process and get multiple offers is to really be able to select someone you think will add a lot of business, a lot of value to the business, and the idea of, one, it creates a commitment level. It's they have to be more involved as a fiduciary if they're on the board, and also you should be lucky enough to have someone that's sort of sees this across portfolios. So I think trying to keep the board relatively small is good, and I also think as we've grown, we find a lot of value in having other executives, operators, or independent directors on the board as opposed to just investors. I love all my investors. They've been great and they're supportive, but most of them sort of, show up and want revenue to go up, gross profit to go up, and burn to go down. It's like, I also understand that, right? Like I'm working on it, right? So it's sort of a little repetitive process. They understand, they're really good around structuring your next financing and helping you think through that and relationships, but blending that with people that know the business and have operated in your seat, I also think is really, really helpful and important.
Great, thanks. So reviewing a number of the questions, some of them are somewhat specific, but if there were sort of top 3 advice that you would offer for seed stage companies going to market, what would that be above and beyond what you've covered before, which is relatively extensive?
I can take a crack at that. Have a strong argument for product market fit, whatever that may be. I mean, revenue is probably the strongest argument, but it could be customer feedback, surveys, market studies, and so forth. But really, I think that's almost kind of a dividing line between when a company is ready for seed and when it's not. Number 2, which we've talked about, but just be realistic about where the market is. I mean, entrepreneurs have to be optimistic by nature, otherwise the whole system wouldn't work. But there's a limit to that. You have to blend that optimism and can-do spirit with just a reality of where the market is. And number 3, be transparent, honest, integrity. I mean, any whiff of BS or lack of integrity, it's the easiest reason to turn down a deal, and it's instant. So even though it can be uncomfortable, always just stay transparent, stay honest, stay open, and you'll earn the respect of the investor, whether they invest or not. So those would be my 3.
Great. And do you have any specifics around thresholds below which you won't talk to investors? I mean, companies.
We don't have, there's no black and white. I mean, we usually, and I don't know if you're talking about revenue or size of team or, product stage.
Any of those things.
Yeah, I mean, we typically want to see revenue at least a couple hundred K, but then, there could be a biotech company that is 5 years from revenue, but they have technology and science that's so compelling. And it's just the nature of the market. You don't typically see, biotech and medical device companies raising seed don't have revenue yet. But they have, there's something else, they've got a very differentiated IP. So it kind of depends on the segment, but it's some combination of revenue, IP, and just, you have to have a fully formed founding team. We don't invest in one-man shows, one-person shows. You have to prove and you can get a group of people together committed to an idea before we'll look at the company.
Yeah, my 3 are know where you'll be in 2 years and what the range of the company will be worth then, right? And explain it clearly, right? And think backwards. The second is, to Paul's point around team, to really understand who the best 2 or 3 people around you are. And I think particularly if you're early stage, some of those can already work for you and some of them can work for you after this financing, right? To sort of say, I really deeply understand I need a killer salesperson, or I need a killer, CTO, or I need a, whatever the role is, and understand and have a real clear plan of who that is. Ideally, you literally know who it is. At least you really know the profile. And then the third would be, I think at times it's part of running a tight process is try to save some good news and don't share things that you hope happen, but you are not in fact sure are going to happen, right? What you actually want to do is like have just closed a customer, have just hit a revenue milestone, have something and have it in fact done, but then wait and introduce it sort of like, oh, by the way, I know I gave you access to the data room, take a look. Actually, we executed a contract last week. It's in there too, right? Which will do another X 100,000 in revenue or something like that. And sort of be ready with that to create that momentum along the way, I think is also really important.
Great, thank you.
Yeah, I'll kind of share two quick ones. I think one is more so now than ever, you really have to have a plan for the cash, because it's really shifted from grow to make sure you've got runway for a long time, as long as possible, and be really thoughtful about where you're allocating this resource that you're going to get, and being intelligent with that. So that's, I think, one that I would put as really high priority that maybe is different from years past. And the other is I try and go find other founders that are sort of in similar type industry or in your industry that are going through the same stage. It's been really valuable for me over the last couple of years is to have really good contacts within this kind of broader. So we're in the consumer brand sort of digital space and talking to a lot of other founders in this area, so that you can kind of understand sort of the dynamics of what's going across, both from your customer side, but also from the investor side. And so it's been really helpful.
Great. Well, thank you. With that, I think we're going to lose one of our panelists in 3 minutes. So want to thank Connect for bringing us all together and having this panel. And Spencer, Dan, and Paul, thank you for joining us and sharing your wisdom here. Peter, anything on your side?
Yeah, this has been fantastic. Thank you so much for Victoria for moderating today's session, and Dan, Paul, and Spencer for joining us. There's a wealth of information that each of you have provided today, and I'm hoping that this is great insight for all of those who listened in as well. And to everybody out there who attended, thank you so much for joining us. I hope you found it very insightful for the companies that you're building and growing. This webinar is recorded and will be made available to everyone within about a week's time. And we hope you'll be able to join us for future sessions about capital insights. We wish all of you a wonderful day, and thank you again so very much.
Thank you, everyone.
Great.
Appreciate you joining.
Thanks, everybody.
Thank you.
Bye-bye.
Thank you.